Hello and welcome everybody to another episode of Books and Bytes. You know the drill by now, we're here for a deep dive. And today, we are taking on a real heavyweight,
Mm-hmm.
the Fama Portfolio.
Yeah.
Selected papers of Eugene Fama, a collection edited by John Cochrane and Tobias Moskowitz.
Yeah, and this isn't just, one paper. It's a whole journey, decades of work that really built modern financial economics.
That's exactly it. Think of this collection as giving you, the listener, a front row seat to the big breakthroughs, the big debates, how markets work, how assets get priced.
Even how companies make those huge decisions, like about paying dividends or how they get funding.
Right. And our mission here is, well, to cut through this massive amount of work and pull out the key stuff, the insights, the surprises, the things that really shifted how we think about finance.
You want to see the evolution, right, from that core idea of efficient markets.
Yeah, all the way to the complex models like CAPM and then the multi-factor models later on.
And you'll see these main themes pop up again and again. Market efficiency, obviously. Developing and testing asset pricing models.
Big contributions in corporate finance, too. Agency problems, financing decisions.
Oh, yeah. And then there's the work on interest rates, exchange rates. I mean, it's a body of work so foundational, so influential.
Well, it earned Eugene Fama a Nobel Prize.
Definitely. Okay, so let's dig in. Where does this story really kick off in the collection? Market efficiency seems like the place to start. The early idea was this random walk, right?
Right. The idea the price changes were basically unpredictable, just noise. But the sources here clarify that later work, think Samuelson 65, Mandelbrot 66, they refine that.
Refined it how?
Well, they showed the real implication of prices reflecting all available information isn't quite a pure random walk. It's more that prices are sub-martingales. Sub-martingales. Okay, what's the intuition there? Sounds a bit technical.
It is, but the core idea is crucial. Prices don't have to be perfectly random. What matters is that the expected value of any abnormal return, given what you already know, is zero.
Ah, okay.
Yeah.
So prices react instantly and correctly to new information.
Exactly. So your past knowledge doesn't give you an edge in predicting excess returns. You can't consistently beat the market based on old news.
So it's not that prices are completely unpredictable, but that you can't systematically profit from any predictability after you account for risk and time value.
You got it. Any predictable return is just, compensation for risks or time. The truly new stuff, the news, that's what drives unexpected changes and makes it impossible to earn those abnormal returns consistently.
And this is where it gets really practical, right? The birth of event studies. The book points out that early on, Fama couldn't even easily get standard market data.
It wasn't readily available.
Yeah.
Jim Laurie at Chicago was building the CRSP Database Center for Research and Security Prices, famous now.
Right.
And he needed to show its value. So he suggested, hey, why not study stock splits?
Which led to that huge 1969 paper, Fama, Fisher, Jensen, and Roll. Why is that paper such a big deal?
Because it laid out a clear, systematic method, the event study methodology. It showed how to measure precisely how quickly and how completely stock prices react to a specific public event, like that stock split announcement.
It was a way to actually test market efficiency against real-world information, empirically.
Exactly, a rigorous tool. And that method just took off, became standard.
And it even ended up being used in, legal cases, right? Calculating damages from fraud by measuring the market impact of hidden or revealed information.
Yeah, it fundamentally changed how empirical finance research got done. Really powerful stuff.
So, stepping back for a second, the book paints a picture of finance before all this. Investment courses were focused on security analysis.
Pretty much. Trying to find those individual mispriced stocks, it was, more art than science. Lots of qualitative judgment.
Less theory, more intuition.
Kind of. The big shift started with Markowitz in '59. Portfolio selection. Thinking about risk and return together for a whole portfolio.
And then building on Markowitz came the CAPM, the capital asset pricing model. Sharp, Lintner, mid-60s. That was revolutionary, wasn't it?
Absolutely revolutionary, because for the first time, it gave a precise, testable definition of risk beta and a clear prediction about how that risk should relate to expected return across all assets.
Before that, risk was just fuzzy, hand-wavy.
Totally. Subjective. CAPM put structure on it. The sources mention how even brilliant earlier work, like Modigliani and Miller on capital structure in '58, they had to kind of work around the lack of a formal risk-return model. They used assumptions about risk classes, but it wasn't as rigorous.
So CAPM provided that missing piece, a concrete way to measure and price risk.
Exactly. It changed how theory was built, how it was tested, a massive leap forward.
Okay, so Fama is changing how we see market prices, but he's also digging into the firms themselves. Corporate finance. The book highlights the Jensen and Meckling paper from '76 on agency problems, hugely influential.
Oh, absolutely a cornerstone. That conflict of interest when ownership and control are separate, right?
Yeah.
Managers acting as agents for shareholders, the principals, but maybe their interests don't perfectly align.
And Fama's own work in 1980, his theory of the firm, built on that.
Yeah.
But he focused on the managerial labor market.
Yeah, this is a really neat insight from Fama. He argued that the market for managers hiring, firing, promotions acts as a powerful discipline. It enforces what he called full ex post settling up.
Full ex post settling up.
Yeah.
Okay, break that down. What's the intuition?
So think about it. Even if it's hard to measure exactly how well a manager is doing right now, or things are changing fast, the job market is always watching, always assessing.
Right.
Based on how things turn out, their future pay, their career path gets adjusted. They get rewarded or penalized later for what they did earlier, even if the impact wasn't totally clear at the time. It's like this continuous settling up through their career.
Like a delayed feedback loop. Makes sense. And then he and Jensen, in '83, looked at how this separation decisions versus risk-bearing works in different kinds of organizations, not just big corporations.
Right. Partnerships, mutual funds, nonprofits, you name it. Their point was that in complex outfits, where knowledge is spread out, well, it's actually efficient to delegate different decision roles.
So you separate initiating and implementing decisions.
From ratifying and monitoring them, control functions.
That separation helps manage those agency problems, puts checks and balances in.
Exactly. They argued it's an efficient way to structure things when complexity and agency issues are involved.
Okay, let's loop back to testing market efficiency. The book walks us through the different forms of tests. Started with weak form, right? Just using past prices to predict future returns.
Yeah, the random walk stuff and the early studies, they found very little you could actually use. Sure, sometimes in huge data sets, you'd find tiny statistical correlations, like maybe 0.06.
But not enough to make money after costs.
Generally, no, not reliably. And that Fama and Bloom study in 1970 was key. Showed trading rules based on past patterns usually couldn't beat just buying and holding.
Which fits the sub-martingale idea perfectly.
Yeah.
Past prices tell you about expected returns, but not the abnormal returns you need to profit.
Exactly.
Then came semi-strong form tests, looking at how fast prices react to other public info, not just prices, earnings, stock splits.
Right. And this is where those event studies we talked about were the main tool. The evidence here, mostly, was pretty supportive. Markets seemed quite quick at digesting public news.
Okay, but then the strong form, the toughest test. Does anyone, even with private information, have an edge?
And the book's straight up about this. Unsurprisingly, no. The strong form doesn't hold perfectly. Studies showed NYSE specialists, corporate insiders, people with real private info could make abnormal profit.
So the strong form is more like a theoretical benchmark. Ideal information reflection, not reality.
Pretty much. It shows the limits. Public info gets priced in fast, but private info, that can still give an advantage.
But even if public info is priced efficiently, the book gets into findings that, well, complicated things. The anomalies. Things that didn't fit simple models like CAPM.
Oh yeah, the empirical puzzles. And they looked at predictability over different time frames.
Like a short-term predictability.
Yeah.
French and Roll in '86 found stock price variance was way higher during trading hours. Maybe trading itself adds noise.
That was one idea. And then Jagadish and Titman in '93 documented that short-term momentum or continuation. Past winners keep winning for a few months. The book calls that an open puzzle, especially for smaller stocks.
But then there's long horizon predictability. Fama, in French again, 1989, they found things like dividend yields, default spreads, term spreads. They could actually forecast returns on both stocks and bonds over longer periods.
Right. That was huge. It suggested expected returns aren't just constant. They change, they vary, seemingly tied to the economy, to business conditions. And this variation seemed common across different assets. They argued it was rational variation.
Okay, but the really famous anomalies, the ones that hit CAPM hardest, were about explaining the cross-section of returns, right? Why some stocks consistently outperform others over the long haul.
Absolutely, the big ones. The size effect, bands 81. Smaller stocks historically had higher average returns.
And the value effect, Fama and French 91. High book-to-market value stocks did better on average than low book-to-market growth stocks.
And Fama and French's work in the early 90s showed just how powerful these two effects were.
How so?
Well, they found size and book to market seemed to soak up the predictive power of lots of other variables people thought predicted returns. And maybe even more critically, their 92 and 93 papers showed that once you accounted for size, that classic CAPM relationship between beta and average return, it looked really weak, maybe even flat after 1950.
So the size effect was swamping beta. CAPM's main prediction wasn't holding up well in the data, especially alongside these other factors.
That's what the data strongly suggested, yeah.
And the book mentions other long-term puzzles, too, like IPOs and SEOs tending to underperform later, or firms doing acquisitions underperforming.
Yeah, and firms repurchasing shares tended to do well. It raised questions. Does the market sometimes overreact, like to the hype around an IPO? Or underreact, like maybe not fully appreciating the good signal of a share buyback?
Which brings us to that fundamental challenge you mentioned earlier, the joint hypothesis problem.
This is so important. You can't test market efficiency in isolation. You always have to assume some model for expected returns, for risk.
If your test fails,
You don't know why. Is the market inefficient? Or is your model of risk and return just wrong? The bad model problem.
it's a catch-22. And the sources suggest maybe a lot of these anomalies are bad model problems.
That's definitely a perspective Fama puts forward. He points out many anomalies are stronger in small stocks or fade away in value-weighted portfolios where big stocks dominate. That fits the idea that maybe the simple CAPM was just missing important risk dimensions like size and value.
Which leads directly to the Fama and French three-factor model from 1993, addressing the bad model problem by building a better empirical model.
Exactly. They added factors for size SMB, small minus big, and value HML, high minus low, book to market, alongside the overall market factor.
And this model did a much better job explaining the differences in average returns across various stock portfolios. It captured those size and value effects.
A much better job. It wasn't perfect, but it absorbed many of the anomalies that plagued CAPM. They interpreted SMB and HML as potentially mimicking portfolios for underlying risk factors tied to, say, relative distress or profitability prospects. They used tests like the GRS statistic to show it fit the data better.
And it basically became the new workhorse model in empirical finance for a long time.
For decades, yeah, the benchmark.
Okay, shifting gears slightly, but still within the firm focus. The collection also covers Fama's work on corporate finance decisions, like dividend policy. What were the key findings there?
Looking over time, Fama and French found in 2001 that fewer firms were choosing to pay dividends, even after you control for things like size, profitability, investment needs.
Interesting. A declining propensity to pay.
Yeah. And they also found a lot of inertia. If a firm paid dividends last year, it was way more likely to pay this year. Sticky decisions.
And what about financing decisions? How firms choose debt versus equity?
So Fama and French tested competing theories in 2005. The main ones being the trade-off theory and the pecking order theory.
Pecking order says firms prefer internal cash first, then debt, then equity only as a last resort, especially if they need cash.
That's the prediction. But their data threw some cold water on that. They found firms issue equity surprisingly often. A big chunk of firms do it each year.
Even firms that don't seem desperate for cash.
Yeah, even firms without financing deficits. And repurchases were common too, even for firms that did have financing needs. The strict hierarchy predicted by the pecking order. It just didn't seem to fit the facts that well.
So again, the empirical reality didn't quite match the neat theory.
It's a pattern, right? Let the data speak, challenge the assumptions.
The collection also gets into macro finance territory. Fama's work on interest rates and exchange rates. That 1975 study on short-term rates.
Yeah, a really interesting finding there was that the expected real return on very safe short-term T-bills seemed pretty constant over time.
Constant real returns.
Mm-hmm.
So when nominal rates move, it's mostly inflation expectations changing.
That's what it implied. Most of the ups and downs in short-term nominal rates just reflected shifting views on future inflation, not changes in the real reward for lending safely. He found nominal rates and expected inflation were very persistent, almost random walks themselves.
And what about longer-term rates, the term structure, forward rates?
Also revealing, he showed that forward rates, what the market implies future short-term rates will be, are actually pretty bad predictors of actual future spot rates.
Wait, that seems backwards. Why?
Because most of the movement, the variation in those forward rates, wasn't coming from changing expectations about future rates. It was coming from changes in the risk premium embedded in the forward rates.
Ah, the compensation for locking in a rate for the future.
Exactly. And these premiums weren't constant. They varied over time. And interestingly, they tended to be negatively correlated with expectations of future spot rates.
So when expected future rates were low, the premium was high, and vice versa.
Sort of, yeah. It suggests expected returns on bonds change with the business cycle in ways that simpler theories like the pure expectations hypothesis didn't capture.
And he found similar stuff with exchange rates.
Very similar patterns, actually. His 1984 work showed forward exchange rates were also poor predictors of future spot exchange rates.
Same reason. Time-varying risk premiums dominating.
Seems so. Most of the variation in forward exchange rates was also due to these changing premiums, not changing expectations about future spot rates. And again, the premiums and the expected spot rate changes were negatively correlated.
How did he interpret that?
Well, using frameworks like interest rate parity and purchasing power parity, it suggests that expected real returns on bonds differ across countries and change over time. It points to time-varying international risk premiums.
So across different markets, bonds, currencies, the data kept highlighting these changing expected returns, these dynamic risk premiums, things simple models often missed.
Definitely. It reinforces that markets are complex, dynamic. Understanding expected returns means grappling with how risk and the required compensation for risk change over time.
Now, throughout all this empirical work, the collection also makes clear Fama's methodological contributions, or how he used methods effectively. Event studies, obviously.
Absolutely central. And Fama-Macbeth's regressions. That two-step approach is just fundamental in empirical asset pricing. The sources praise its transparency, its relative simplicity, the robust standard errors.
Plus that intuitive portfolio interpretation it gives you.
Right. And just the basic idea of using portfolios in empirical finance, grouping stocks by size or value or whatever characteristic, that's huge.
Instead of getting lost in the noise of individual stocks.
Exactly. Average out the idiosyncratic stuff, isolate the common factor you care about. It's a foundational technique he helped pioneer and popularize.
And finally, the book touches on that really tricky issue, separating luck from skill in investment performance, citing Fama and French's 2010 work, using tools like the false discovery rate.
Yeah, that reflects the ongoing push for rigor. How do you know if a fund manager who outperformed did it through genuine skill or just got lucky? Or maybe their benchmark, the model used to judge them, was wrong. It's about refining the tools to tackle that bad model problem again from a performance evaluation angle, making sure patterns are real.
Wow. Okay. Stepping back, the sheer scope here is just incredible, from market efficiency foundations to asset pricing models, corporate finance, macro finance.
And the methodological impact on how finance research is done, event studies, portfolio sorts, regressions. Diving into this collection really shows you how the field evolved, driven by data, by empirical testing, by constantly asking, does this theory actually hold up?
It's a powerful case study in the scientific method applied to finance. Even the most elegant theories have to face the data.
Couldn't agree more. Rigor and honesty with the data.
So, as we wrap up this deep dive into the Fama portfolio, here's something for you, the listener, to think about. It comes right out of all this research we've discussed. Given these ongoing debates about just how efficient markets really are, the persistence of some anomalies that our models struggle with, and how genuinely hard it is to statistically prove skill versus luck. How much can we truly say we know about expected returns?
I mean, what does that uncertainty, that gap between our sophisticated models and the messy reality of the data actually mean? How should it affect how you think about investing? Or, what are the big questions finance research still needs to crack?
Definitely something to chew on. Thanks for joining us for this exploration of Eugene Fama's immense contributions.
Yeah, this was a great one. Really foundational stuff.